Good day and welcome to the CDFI Funding Sources for CED-HFFI Projects conference call. Today's conference is being recorded. If you'd like to ask a question over the phone at any time during the call, please press star 1. At this time, I would like to turn the conference over to Matthew Lee. Please go ahead, sir.
Hi, everyone. Welcome to the CDFI-HFFI webinar. It's 1 p.m. or 1:07 p.m. Eastern Time, 11:07 Pacific Time. So good morning to everyone west of Mountain Time, and good afternoon to everyone on the east. We have over 100 people registered for our convening, and it looks like there's a diverse group here of community development stakeholders from CDFIs and community development organizations, some of which are current prospective CED grantees. The group also includes some government agencies and beyond, so thank you all for joining us. My name is Matthew Lee, and you'll be hearing my voice moderating over the next hour. I am the founder and managing partner of Homegrown Advisors, which is a network of development experts providing technical assistance to prospective and current CED-HFFI grantees at the forefront of community development initiatives across the United States. What brings us together today is a motivation to make our community stronger, and we're fortunate to have 3 community development financial experts joining us today, each of whom will share their unique perspectives on CDFI-HFFI funding. And before we get started, though, I'd like to thank the Office of Community Service for providing the resources to organize and hosting this event. And we're lucky also to have Karen Harris from OCS joining us, and she'd like to say a few words to kick off the conversation. Karen?
Thank you, Matthew. Hold on a minute. My computer is crashing. Okay, here we go. Thank you very much, Matthew, and thank you to everyone who has taken the time out of your busy day in your schedule to join the webinar as we bring you some information. Hopefully that'll be very useful for you for CDFI funding for your CED and your CED-HFFI projects through the Office of Community Services. So the Office of Community Services is very pleased to convene this webinar, and this webinar features a great panel of experts that are going to discuss the CDFIs, or the Community Development Financing Institutions, and how they can serve and supplement funding as a supplemental funding opportunity for community development or for healthy food-focused activities. As many of you on the call may know, Community Economic Development Programs, or the CED program, is a federal grant program funding community development corporations that address the economic needs for low-income individuals and their families through the creation of sustainable businesses and employment opportunities. We hope today that this presentation will provide some interesting information relevant for current and future CED grantees, as well as other organizations that have joined us today and that are engaged in community development projects. Again, I want to say welcome and thank you for joining us, and please enjoy the presentation. And then I'm going to turn it back over to Matthew.
Thanks, Karen. So I'm sure many of you have experienced the access to affordable financial products and services is important for economically sound community development projects, and at least 1/4 of American households don't have a bank account or rely on expensive alternatives to capital. So we're lucky to have CED support and support of CDFIs to help fill these gaps for alternative financial products and building the capacity of CDFIs to catalyze the revitalization of our communities here. Since 1994, the CDFI Fund has awarded about $1.9 billion to CDFIs, community development organizations and financial institutions, and in 2015, the Healthy Food Financing Initiative, which serves as a supplemental funding opportunity through CDFIs for healthy food-focused financing activities. So you'll be hearing from 3 experts over the next 45 minutes. each of whom have unique perspectives and approaches from their organizations and their past experiences, all at different stages of the CDFI-HFFI funding ecosystem. So hopefully these different perspectives demonstrate that there are various pathways to play a role as a CDFI in your community. So just a little bit about our panelists today. We'll first be hearing from Cassie Archibald, who is the Senior Vice President of Financial Services at the Opportunity Finance Network, which is a membership-based model, a really unique model that has close to 250 CDFI members from around the country. And OFN plays an integral role in the CDFI Fund program. We'll next be hearing from Curry McCrory, and she's the Community Service Director at the East Missouri Action Agency. And Curry will be talking about her community's CED Fund, which has found alternative funding sources to the CDFI Fund, which I'm personally interested in hearing more about their approach. And then lastly, we'll be hearing from Catherine Howard, and Kat is the Director of Strategic Initiatives at the Northern California Community Loan Fund. Catherine is a pioneer in California around funding healthy food projects, and she has worked at both the national and regional CDFIs, both as a practitioner and a board member. And she's going to talk about NCCLF's new Food Enterprise Lending Program, which, like CED, is capitalized through alternative sources of capital to the CDFI-HFFI Fund program. So before we get started, just a few words here on the webinar format. So we'll each be hearing about 15 minutes each from each panelist, and at any time, any of the participants on the call can ask a question. So in order to do that, you just press *1, and you'll be put into a queue. And at the end, those questions will be opened up. If we don't get to those questions, or if you'd like to send a question in over email, you can send a question at ocsregistrar@icfi.com, and you can also submit a question on the live meeting format, the platform on the Q&A section. Okay, so let's get started. So we'll start off first with Cassie, and Cassie, the virtual floor is all yours.
Great. Thank you, Matt. Thank you to the Office of Community Services and Homegrown Advisors. OFN is very proud to have the opportunity to participate in this webinar and to work with fellow experts in financing projects that increase access to healthy food. First, a little bit about OFN. As Matt was saying, OFN is the leading national network of community development financial institutions, or CDFIs, who invest in opportunities that benefit low-income, low-wealth, and other disadvantaged communities across America. OFN's mission is to align capital with justice. We believe that justice is not just the absence of oppression, but also the presence of opportunity. And access to responsible and affordable financial products is an essential ingredient for opportunity to exist in communities. Our strategic plan focuses on leading CDFIs and their partners to ensure that low-income, low-wealth people and communities have access to affordable financial products and services. Which begs the question, what is a CDFI? CDFIs are financial intermediaries. They operate between sources of capital. Those would be investors and depositors, and uses of capital, which would be borrowers and customers. You might be wondering how CDFIs differ from more traditional lenders. CDFIs generally lend to borrowers who do not have access to mainstream financial services. They generally don't fit a scorecard. They might be perceived as too risky to lend to. Those investors who serve as a source of capital have a motivation. Generally, it's based in mission, policy, or regulatory requirements such as CRA, or the Community Reinvestment Act. And investors look for returns that are related to outcomes and justice. Currently, there are about 1,000 CDFIs that exist in the United States. They're concentrated in credit unions with $44.6 billion in total assets. Second is banks at $37.7 billion. It's followed by loan funds at $14.7 billion, and lastly, venture capital funds at $2.4 billion. Access to capital is part of the long-term solution to alleviate poverty and to build healthy communities. And to that end, CDFIs strive to become a permanent capital resource in their communities. And CDFIs have a mission to serve the geographies that they exist in. So they're not part of a program that can come and go at the whim of a funder or the government. And this means that when CDFIs make loans, they need to be repaid. So CDFIs can't avoid risk when they're lending into a project, but they have to find a way to manage it. Here are some of the products that CDFIs offer, and you'll notice that for the most part, they offer all the same products as commercial lenders, but CDFIs aren't regulated by the government the way commercial banks are. So they have some flexibility around how they structure their loans, and they don't have to adhere strictly to certain ratios such as loan-to-value or debt service coverage when they make their credit decisions. In addition, you'll notice that they also offer technical assistance and training and advocacy as part of the services that they offer. This image simply illustrates the fact that CDFIs can be found anywhere in the United States. This screenshot was taken from OFN's website, and our website contains a search tool where you can search for a CDFI in your geography based on specific criteria, including the types of lending that the CDFI does. Here's some resources to help you locate a CDFI in your area. There's a search tool on the U.S. Treasury website, and again, there's a search tool on OFN's website. Both of the websites offer great information about the CDFI industry and community development in general, in addition to these search functions. Some examples of transactions in the healthy foods arena that CDFIs have financed are given here. These examples show that CDFIs have an array of financing tools from straight debt, including construction loans and bridge financing, to new market tax credit financing. In the first example on the left, the reinvestment fund provided equipment loans and fit-out financing to help fund a new full-size supermarket in Newark, New Jersey. The second transaction in the middle financed the first nonprofit grocery store in the United States. The project required a complex array of financing tools from a number of lending partners, and this included the use of new market tax credits and bridge financing to fundraise sources. The last example is a transaction that financed the relocation and expansion of a farmer's market in Flint, Michigan. This project is part of a larger redevelopment in that area, which improves access to healthy food and high-quality health care. So you can see that there's a good deal of variety in the tools that are available to finance projects, as well as variety among the project types that CDFIs will finance. So the next couple of slides just show you where you can find some resources, where you can, these resources provide a deep dive on how the projects are underwritten by lenders and how they're structured. The CDFI Fund website contains a resource bank with webinars and training materials on how to finance healthy food projects. So you can see on the screenshot that you have access to course material, case studies, mapping tools that help you analyze market data, and just a rich variety of resources to help you understand how to go about financing your project. The website also has a webinar archive. These webinars speak to various topics about financing your project, including how to analyze your target market, how to put together a loan application, and how to attract financing, for example. But these are just some examples. There are a wide variety of webinars that are given on the website. And here's my contact information. Thanks again to Laura and Matt for inviting OFN to participate. I welcome any questions or inquiries that you might have. And at this point, I'll hand off to my presentation partner, Carrie McCrory.
Well, thank you, Cassie. As Cassie said, my name is Carrie McCrory, and I'm the Community Services Director at East Missouri Action Agency, and we are a community action agency in southeast Missouri. And my role in the CEDS organization is I just oversee the project. It's called the Southeast Economic Development Fund, commonly referred to as CEDS. So my first thing I want to do is I'm going to talk about why and how we got where we're at, and then I'm going to talk about where we're at now, our successes. So each year, first of all, let me give you a landscape of our 8-county service area. We have a very small county with a population of 10,000 up to our largest county, which is a population of about 68,000. And our poverty rates range from 11% to 24% in our service area. So every year under the Community Action Agency, or every 3 years, we are charged with completing a community needs assessment. And the results of that assessment always identifies the lack of jobs as a major issue in our area. So one of the things that we did was we really took a hard look at our community needs assessment. And out of that really came the CEDS organization. You can move to slide 2 now. The leadership team at EMAA started brainstorming about other ways in our traditional services on how we can make an impact on creating jobs in our communities. And additionally, we wanted to become a better and more prominent player in economic development. We knew that small businesses in our area were struggling and, even closing. We also knew that access to capital was extremely hard to find with the current state of our economy in our 8-county area. So we decided that we would research deeper into the needs of the small businesses and see if there was a role that we could play in helping them access capital as well as assist them with their development services. Thus, the reason why CEDS was created was in response to our desire to take a more active role in helping micro and small businesses grow and create jobs in our rural communities. Next slide. So 3 years ago, the vision of CEDS was born. We have been working since that time to provide capital to our local small businesses, assist with training and technical assistance, and also provide access to resources. The first thing that we did, we reached out to the revolving loan fund, small business development world, and we tried to learn as much as we possibly could. The first thing we learned was that we really needed some professional help from the experts in the CDFI world. So we sought out consultants to help us better understand the delicate intricacies of the small business development services and the revolving loan funds in addition to CDFI. We really wanted to know if what we were proposing was even feasible in our area, and so we ended up hiring a consulting firm, and that has proven to be the best thing we could have done. We worked closely with our consultants. The first suggestion was to complete a market scan, in which we completed that scan, and we found out that local businesses was actually having trouble accessing the Small Business Development Center that serviced our 8-county area because it was nearly 90 miles away. There were also very few alternative lenders in our service area, particularly those for loans of less than $50,000. And we also learned that there was ample opportunity to build and develop strong partnerships in our communities with regard to helping small businesses and accessing that capital. So one of the things that we did was we conducted focus groups. One of those were with small businesses to find out their needs and expectations of an organization such as CEDS. And we also met with local bankers, industrial development authorities, Chamber of Commerce members to find out what they thought the needs were. So after we completed the market scan and the focus group meeting, it was clear that CEDS and EMAA needed to become a player and figure out how to address the gaps. What was really important to us, though, is we wanted to lay a very strong foundation to achieve the goals that we had in mind. Next slide. So under the advisement of our consultants, we created an advisory board, and this board helped us create our legal entity. The EMAA leadership team and board felt strongly about creating a separate entity that was, so our identities were separate from EMAA and CEDS. EMAA has traditionally provided services to low-income families, and we thought the businesses and the community itself would see CEDS in a different light, and that was really important to us. So we developed the CEDS as a 501c3 nonprofit organization, and then we moved into developing the mission. The financing entity was created. We determined our target market, and we started talking about what development services should be provided based on the identified needs from our focus group. Once the legal aspects of the organization was in place and what development services we were going to provide, we began to market the program to other organizations who had expressed those partnerships during our market scan. Those organizations included local community banks, again, Chamber of Commerce. We had some private foundations, USDA, and the local community college. So we focused our initial efforts around small business development services. That's where we started, and we started providing those services long before we started providing any loan activity. We have moved into the loan activity now, and we have moved quickly into the capital building piece. Next slide. On our first ask to a local community bank, they offered us $25,000 donation to help us build the program. And additionally, the local industrial development authority donated $36,000. And most recently, we've received in operating and capital funds from the USDA Rural Business Opportunity Grant, the RMAT program, the Rural Business Development Grant, and we have two private, actually one private, the Iron County Economic Partnership is a foundation, and also the Washington County Industrial Development Authority. We've created a portfolio with nearly $1 million in capital over the course of 2 years, about 2 years. And to date, we have closed 4 loans, our first loan being in February of this year. We have assisted over 100 small businesses with our development services. As you can see, we're not a community economic development grantee. We do expect to apply in the future for those funds, and we are working on our application to become a certified CDFI and hope to be able to tap into the U.S. Treasury funds under the CDFI Fund. And we continue to look for capital sources as well as operating funds for our program. Next slide. My presentation was short, but I want to thank you for your time today, and if I can be of any assistance, you may contact me at any time. I've also listed my colleague, Janie Radford, there. She's our small business development coach. She would be willing to help answer any questions you might have. You can also check out our Facebook page at Southeast Economic Development Fund and our website at www.cmodevelopment.org. And again, I thank you, and thanks to Laura and Matt for asking us to participate in this. And so I'm going to hand this over to Kat Howard from the Northern California Community Loan Fund.
Great. Thank you very much. Hi, everyone. My name is Catherine Howard, and I'm the Director of Strategic Initiatives at NCCLF, where, among other things, I've worked on launching our food systems lending program over the last year. I was also previously the fund manager of the California Fresh Works Fund, where I oversaw about $54 million of investments into healthy food financing projects in California. Oops, let me get this slide going the right way. So NCCLF is a 28-year-old regional CDFI that serves Northern and Central California, which is an area that spans basically from Bakersfield in the south up to the Oregon border. And we do a variety of things with a focus on lending and in-depth consulting and technical assistance. Our approach to community development is to match capital and support to the community organizations that can have positive impact in their local areas. So NCCLF has historically been a loan fund that lends to nonprofits for traditional community development work, mostly real estate lending for projects like affordable housing and social services. But in our last strategic planning process, we wanted to explore new ways to engage with needs, particularly in the rural and agricultural-focused communities we serve in the Central Valley and the Central Coast of California. This has been a really big change for us since we are now doing business lending and working with for-profit companies, both things that we had never done before. So planning for that change and putting in place systems and partnerships were a hugely important part of our process. We knew we didn't have all the expertise we needed in-house for this new line of business, so some of our key first steps were to engage with experienced players. And this has included setting up an advisory committee and creating one-on-one advisory relationships with people who have relevant experience to help guide us. We've also created partnerships with other lenders where we can complement one another and at the same time NCCLF can learn from their expertise. We've contracted with technical assistance and business development groups that have helped us build a book of contacts and given us a good place to refer clients for additional help should they need technical assistance. And in addition, we engaged with our board in a way that made clear that this was a very new program for us that would have a different client profile than what they were used to and would likely be iterative in its development and execution, which I think has been really important. To underscore this, we actually had a board-designated separate loan pool from our general lending assets just for our food work, which was really a first step for NCCLF. We have traditionally been a blind pool that's been only one pool. So that was a really important step for us to be able to engage in this new line of work and to communicate to our board and all of our stakeholders that we understood that this was a new line of work and was going to be iterative in terms of our process. So we also wanted to get real clear on why we wanted to get into food lending. Because of the unique characteristics of our region, we didn't just want to focus on retail. Many organizations that are involved in healthy food financing really focus on retail, and that's been a primary focus of the program in general, including at the federal level. But instead, NCCLF is working across the food value chain with a focus on three impacts. Asset building, so creating employment and income opportunities for low-income people so they can build their assets, contributing to a resilient food system, so projects that either have environmental stewardship or are locally based and contribute to local economies, and then also retail and increasing access to healthy, culturally appropriate food for low-income households. So how has this shown up as lending for us? So we launched this program this year, and to date, we've done 8 food-related loans and expect that we'll complete 2 more by the end of the year. So I want to walk you through some so you get a sense of the breadth of the work that we're doing. So one of our first partnerships that we developed was a co-lending relationship with another CDFI that is in our region. Their name is California FarmLink. And FarmLink has decades of experience providing TA to small farmers and emerging farmers and developed a lending program several years ago. So we agreed to partner with them to co-lend as a mutually beneficial relationship. We have learned a ton from them on underwriting small farms and producers, And because FarmLink is a relatively small CDFI, the capital that we've brought to the relationship has allowed them to stretch their balance sheet to make more loans and to provide bigger loans. So here's an example of a farmer and producer loan that we did with them to Bucio Organic Farms. You can see Roberto Bucio there. One of the types of problems that small farmers like Rigo run into, and one of the reasons why CDFIs are so important in this area, is because typically very small farmers are looking for financing that's relatively low dollar amount. It's not necessarily something that's interesting to do to traditional lenders. Or, in particularly here in California, we have a number of small farmers who are former farm workers who may not have full legal immigration status, and therefore lenders cannot access guarantee programs that they would be otherwise able to access for other farmers. And so those folks are frequently left out of the lending environment. So in this case, we provided financing to Rigo so that he could use it for his preseason expenses, basically buying seeds and things of that nature. And he was doing some work around diversifying his farm's crops, which the goal was to increase his total net income, falling in line with our mission goals. So this is a different kind of loan that we did. So one of the challenges working in rural communities when considering access is that many small communities have insufficient population to support a full grocery store. So NCCLF, we've been exploring alternative ways to increase access to fresh, healthy foods in rural areas, and one of the obvious outlets is schools. Many of California's school districts are focusing on increasing the amount of produce they serve with an emphasis on local purchasing, so this worked out nicely for us. So the loan that we made this year to AgLink fits many of our desired impacts. AgLink is essentially acts as an aggregator and distributor, facilitating large industrial buyers or institutional buyers like school districts to buy from small farms and producers. So this increases the amount of fresh, healthy food that the institutions like the school districts can serve while supporting a resilient local economy by buying local. So our loan in this case helped AgLink build out a cold storage and buy equipment to support increased capacity. And over the life of the loan, they expect a 100% increase in school district buyers to be able to work with many, many more farmers and producers as sellers. And they also expect to create at least 8 new jobs in a very small rural community. So this is an example of kind of how this food work has fit in with maybe our more traditional work at NCCLF. So with the launch of our food work and an increase in our marketing outreach and partnerships in the food world, we've also come across opportunities like the YOLO Food Bank that are more like our traditional line of social service business, but with a food component. The particularly nice thing about this project is that what we've done is help the YOLO Food Bank extend its space, and they've created a new commercial teaching kitchen. So while they are doing traditional work that like food banks do and distributing food, they also have a component of their work that involves bringing local healthy produce to the food bank, and now they are taking that one step further and actually providing nutrition education to the community and cooking classes to people who are using their services and the general community. And then finally, we've been able to support a more traditional retail type project in a shopping center with a market that is an anchor tenant in an area of Paso Robles where there are no stores. So this is an area that was built out relatively recently in the small town of Paso Robles. There are over 300 units of new housing, most of it affordable to people who are low income, and there's really just no shopping there at all. And so we were approached to provide a leverage loan and an upper tier bridge loan for the retail shopping center. And this is something that we would normally not have done and we wouldn't have even considered before this year. But because it is anchored by a grocery store, a Latino grocery store that is going to do a big expansion in this area, we were able to take a look at this project and participate. So about our capitalization of our food fund, we are a certified CDFI. We have received FA awards many times, but we have not yet applied for an HFFI grant. This is for a couple of reasons and been intentional and for a couple of reasons. First of all, 75% of funding from the HFFI has historically had to be used for retail work, and we knew when we were getting into this process that we would likely not be doing most of our work in retail. And so we wanted to be able to launch, take a look at what we were doing, and then kind of reconvene and determine whether or not HFFI funding through the CDFI Fund was the right type of source for us. Secondly, having worked with the source in the past, I knew that the grant application really requires a very strong pipeline of transactions, and since we were just getting into the business, we didn't feel like we had a strong enough pipeline of transactions. Instead, we have partnered with various funders interested in food system work for base capital for our fund. And so you can see here, JP Morgan Chase through the Refresh Cohort Grant, Citibank also provided us a grant. We've also dedicated a proportion of our own net assets to our food fund. So we were in a healthy position with our net assets, and we're able to designate just some of our internal capital specifically for this fund. And then, and I think most importantly for us long term, we take a lot of individual investments. So people can individually invest in NCCLF. We also have a lot of foundations and other mission-driven organizations who invest in us. And we have recently updated our prospectus with our securities permit, actually just got approved yesterday, so that we can add investors to our food fund. And because there's such an interest in healthy food and food access, particularly here in California, but I really think across the country, we know that there is a real interest out there from both individuals, foundations, and other organizations in investing in this type of work and activity. So we feel like this is going to be a strong way for us to be able to build capital for the project. So finally, in conclusion, as you are thinking about your projects and whether you want to be doing healthy food financing work, some of the lessons that we have learned is to really, not be hemmed in by what are the specifics around the HFFI program, but to identify unmet needs in your geographic area. We are working in retail, but we're also working across the food value chain. We have found that partnerships are really essential, and that goes, from everything to learning about how to do this work to building a book of business to just getting the right contacts in the right places. And then consider many possible capital sources based on the type of lending that you want to do, and considering whether or not you want to provide things like technical assistance or grants or other things to support the work that you're doing. And with that, I think I will hand this over to Matthew. And thank you very much.
Yeah, thanks, Kat. So just for now, there's, if anyone has any questions, I'm just going to pause for some space, press pound 1, and you can get into the queue for questions. And I'll start. And Kat, I had a question for you, and I was curious because of your breadth of experience in financing healthy food projects. I was wondering if you could talk a little bit more about the types of products that are different, say, between a retail financing and other assets or businesses in the value chain. And one example I looked at was looking at your presentations with farmers, and as you know, there's farmers typically own their land, particularly minority farmers, and they're on a leased land and operating at really low margins with and a lot of times a lot of lost harvest and incredible amounts of risk. So what types of products, or what's your approach there? Do you have any thoughts you'd like to share on kind of your approach at NCCLF to support those farmers?
Yeah, so sure. So I can kind of talk about the different types of products we do across the value chain, and then specifically around farmers. One of the things that I've learned from doing this work for a number of years is in retail. If you're looking at retail, that there's that actually, at least here in California, oftentimes retailers actually don't own their properties either, and so what they're really looking for is equipment financing, working capital, things like TIs, TI financing to build out lease space, and money to basically to help their projects move, whether that's buying inventory or smoothing out their cash flows and things of that nature. With small farms, and I really want to credit California Farm Link, who has been really integral to us learning this. I mean, I think really the key has been, for the most part, what we've seen, and Matthew, you're right, you know, the small farmers typically don't own their land. And so the needs that we've seen have really been twofold. To a certain extent, some equipment financing, and then really things like working capital for pre-season. And what's key with that working capital is you've really identified all the big risks, right? So it's very low margin, particularly with organic farmers. They can oftentimes be in a place where they're, you know, because they aren't using chemicals, pests can come in and really decimate some of their crops. They may not be able to access crop insurance. And so getting to know the farmers well, and I think this is one of the things that FarmLink does really well and is teaching us a lot about, but getting to know the farmers well, getting to know kind of what's the total intention of what they're intending to produce in terms of their crop, and sort of, you know, making allowances for potential for loss. And then also being able to be really flexible around the payment structure. So, you know, farmers are not going to be able to pay you back starting in month one and on an amortized schedule. They're typically going to use your money, do a lot of work, wait for a long time for things to grow, and then harvest what they can and sell that. And depending on all the things, everything from the water to the soil to the pests to, you know, what the market is and how much the market is paying for their crop at the time that they are harvesting, their cash flow is, you know, it's unlikely to be exactly what they thought it was going to be. And so being able to meet those types of borrowers with payment plans that allow them to meet their cash flow needs, and that may require doing suspensions, is really important.
Mm-hmm. So some flexibility with your partners, and then just a different question too, and this is more towards Cassie. Cassie, we have a large group on the phone right now that's mostly nonprofits, and there's community action agencies as well on the phone. And a lot of times the size of the project doesn't qualify for, say, a new market tax credit, which is also available through the CDFI Fund program. And so I was wondering if you could talk a little bit about how a nonprofit that is on the phone who's maybe interested in starting a CDFI or some sort of revolving loan fund like CED would approach OFN, and what resources you could help and provide as support.
Sure. It's a timely question because OFN has just completed the development of a capacity building series that speaks to that. In addition to that, OFN has training on an annual basis in partnership with the CARSI Institute that's just on that topic, how to start a CDFI. And so OFN is a leadership network of CDFIs. One of the services that we provide is that kind of training and technical assistance around best practices in the field and how to get started. So we definitely have those resources available. And then you sort of touched on this question, Matthew, but I don't know if this is exactly what you were asking. But you mentioned if you're a small nonprofit and you're interested in financing a project, it's a little different from developing a loan fund. But I just want to echo Kat's words about the importance of partnerships and also the importance of having many funding sources with varying degrees of subsidy. All of these projects require a lot of subsidized sources in addition to straight debt, especially for the smaller projects that can't use a tax credit subsidy.
Mm-hmm. Mm-hmm. And I'm curious too, just to that point, if Curry, you could talk a little bit about your financing sources. I know that you're in a rural area, and there's a lot of federal funds moving in that direction to support projects in rural development. I was wondering if you could talk a little bit about, sort of alternatives, to the CDFI fund that you were able to access and that Cassie's alluding to. Could you talk a little bit about how you're funded?
Sure. Well, we have really received a lot of support from our local community banks, particularly with their CRA credits, and we have developed a really strong relationship with USDA Rural Development in creating not only the loan fund, but the small business development services. And one of the things that one other funding source is really those industrial development authorities in these smaller communities. They have a hard time attracting large industries because of the population size or whatever reason. So they have some funds available that they've also, been willing to provide to us. And of course, we used our community services block grant funds to help develop the program, pay for all of the creation of the entity, and also provide some of the services through our small business development services, help pay for the staff costs and those things through our operating funds. We did tap into a large pool in our private foundation with that Iron County Economic Development Fund. They are a private foundation sitting on a lot of money, and they're trying to create economic development in their county there. So they saw what we were doing, and in partnership with them, we've recently received $400,000 from them. So we really work closely with our local resources and to try to develop those partnerships so we can help each other.
Great. And then so if this question just came in, if a CDC, and this is for everyone, all the panelists, if a CDC was interested in obtaining loan funds from a CDFI, what kinds of requirements would be expected of a CDC in their proposed project? Cassie, do you want to take that, or?
I can do that. This is Kat.
It's Kat?
Kathy, if you want to start.
Yeah,
if Kathy wants to start, I can.
No, I actually think it's more to you, Kat. So I think that's fine. You go ahead.
Okay. So if a CDC was interested in working on a project that was healthy food related in some way, I think there's some basic things that we always look at, kind of no matter what the type of project is, right? And so there's the 3 C's of credit: the collateral, the cash flow, and actually and the character of the organization. I was like, what's the third one? So we would look at, basically what we would start with is taking a look at what's the purpose of your project, is there a need for it, and how are you benefiting people? And I think as mission-driven lenders, that's really key for most CDFIs is what's the mission benefit, what's the community benefit? And then really the question is, are you capable of doing the project? And so do you have the right staff components? If you're getting into a food financing or healthy food project, have you ever worked in that area before? If not, how are you supplementing your staff so that you can really, bring a informed view to your project? Obviously we look at things like past financial statements for your organization, and then we look at cash flow statements. It's really important that you've thought through whatever the project is and what the projections look like, and how it's going to be able to repay the loan. And then, in capacity, I can't understate it. I think that a lot of nonprofits want to do a lot of things, and they're really good at doing a lot of different things, and just really being able to drill down on what's your capacity to execute in whatever form that it is. So, whether that's putting together a food bank, that's a food bank, and they're going to be doing a nutrition program and a culinary kitchen, or whether that's, an organization that's trying to act as an aggregator for different farmers. It's really about, can you do what you said you're going to do, and how do you have the financial and staff resources to make that happen? And then, there's a lot of kind of in-depth things around credit that I don't need to get into here, but those are really the big buckets.
Cassie, is there anything you wanted to add?
Yeah, just a couple of things. I agree with everything that Kat said. One thing I'd like to add is just to expand upon what I mentioned earlier, and that is that in these projects in particular, the one thing that really stands out when you compare them to other projects that nonprofits need financing for, the operating margins are just extremely thin. And so again, the focus, is on, all of those credit pieces that all lenders have to think about. But the structure and funding sources of the transaction are very critical because there has to be some low-cost funding sources to make the debt service work. The other thing that I want to just draw everybody's attention to is on one of the slides that I presented about a screenshot from the CDFI Fund's website. There are resources there that give you an insight into how lenders will evaluate your project, and anybody that's looking into that would definitely benefit from taking a look at the material that's given there.
Thanks, Kathy.
I would also just add one final thing, which is if you're thinking about a project and you know that you're going to need financing around it, engage sooner rather than later with potential lenders so that you can get a sense of what they need and they can get a sense of what you're doing, and you may need to be making changes along the way. So the sooner you're having conversations, and particularly with CDFIs, this is what we do. We're really good at engaging deeply with our clients and customers and getting to know and understand them. And so I would not say, don't try to put together an entire full package that you think is really great and then call a lender. Have a conversation early.
Yeah, I think just to echo what you're saying, Kat, and this came up in the previous webinar we had in September, is reaching out early, talking to your local CDFI, accessing the OFN website and finding who's available and what CDFIs are close by to you. And oftentimes, if the CDFI you're in touch with early on, as Kat mentioned, if they don't have a financial product that meets what you're looking for, either they have some sort of technical assistance to support your work, to get you to that point to meet the requirements, or the extensive relationships among the different CDFIs and partnerships to hand off those relationships and interests is available. So the sooner you reach out to your local CDFIs, the better. So it looks like our time is short, and just want to thank everyone's time for joining us today. And I'd just like to remind everyone, this conversation is recorded, and it's going to be posted on the OCS website. So if you'd like to share this with your friends or refer back to it, including the materials, that will be found online. And I also encourage everyone to keep checking your inboxes and checking back on OCS's website for future webinars. This is actually the second part of a two-part series. A financial series. The first was Integrated Finance, and that recording is up online, and that talks about all different types of financing beyond public sources and private sources and finding an integrated capital approach. So I highly recommend checking that out. And so until next time, thank you everyone for your time, and thank the panelists for all your time as well.
Thank you for your participation. This does conclude today's call.